All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. The topic of this podcast, as you know, is short selling. Every few weeks, we host an episode where James presents on a new short report, a new short idea that he's discovered, all the research that he's done to make him believe that the companies would make good shorts, and what we think are in the cards for the companies in the near future. We also publish in-depth formal research reports on these short ideas on our website, differentiatedanalytics.com. We're now about 6 months into the creation of the podcast, and since the first short report, and in that time, we published about a dozen of those reports. So today, in this episode, we're going to look back through a few of them and reflect on how each one of them has panned out. It's important to note from the beginning that short selling carries incredible amounts of risk. It's really only suitable for investors who have put in a lot of effort and time into investing, into researching their investment theses. James and I could have positions in any of the stocks we mentioned and can change our positions at any time without notice. So make sure that you do your own work and consult an investment professional before making any investment decision. Hopefully, by the end of this episode, you will see the potential for profit in pursuing a short selling strategy. If you are interested in gaining access to our in-depth short reports, it'd mean a lot if you would consider subscribing to our website, differentiatedanalytics.com, where you'll get access to each of our in-depth short reports. As you can see here, you can see all the reports that we published in the past, as well as updates that we've made to the short positions over the course of the life of the positions. So with that, I'll turn it over to you, James.
Yeah, so these I created these charts which show the performance of all of the stocks that we've written short reports on since we launched the website. And so we can see here, the very first idea we published was Mega Matrix, and we published that on January 23rd of this year. And then for each of the short reports, you can see the date at which time it was published. So on this chart, I show the change in the share price between when we published the report and July 5th, which is the date at which I made this chart. And it shows the change in price. And of the of the 10 positions, 9 of them the stocks have declined in value, and only one of them has increased in value. And this is a good thing because we're releasing short reports. So these are stocks that we believe are overvalued and we expect to decline in the future. And thus far, it's worked out pretty well with the majority of the stocks that we have released short reports on have indeed fallen in price. Of course, this is only we've only been doing this for 6 months, and past performance is no guarantee of future performance. But so far the results are pretty good. Over the past 6 months, the S&P 500 has increased substantially, yet most of our short positions have declined in value. So if we calculate the alpha, which is just the returns of our short positions minus the returns of the S&P 500, our alpha, the excess returns we've generated with our short positions is, extremely good for most of them. So what we're going to do for the rest of the video is we're going to look at, our top 3 winners. That's Ginkgo Bioworks, Mega Matrix, and Fuelcell here. So these are the stocks that we've written up, and they have declined in value the most. And then we'll also look at our one biggest loser, NextNav. So we'll look at, we'll look through the reports that we released at the time, what our bear thesis was, and then why that either played out in our favor, or in the case of NextNav, why that did not play out in our favor. So this way you'll get a sense of kind of what's in these reports and what you can expect from them. So our single most successful position was Ginkgo Bioworks. We released our short report in March when the stock price was about $1.22. And since then, the stock has completely collapsed and has fallen by 70 some percent. So I will pull up the Ginkgo short reports so you can see what we said at the time. So in the report, we go through and explain what Ginkgo Bioworks is, what they do, and then we show their historical historical financial results, and we go through kind of all of the our two major concerns with the company. The first was around their related party transactions, non-cash considerations, and round-tripping transactions. And then the second point that we mentioned was their inability to achieve significant downstream revenue. So those were our two main concerns and why we were bearish about the company. And then we go through a lot of details talking about their, kind of the shady related party revenue things that they historically did. We also talked about they did a really strange transaction with one of their customers, Bayer, where they acquired a facility from Bayer, and then Bayer then started paying them revenue for the based on some services they were providing at the facility that they had just bought from Bayer. So they paid money to Bayer, and then Bayer over the next few years would pay them back, which looks like a round tripping transaction, which is super shady. So we talked about that. And then we talked about the fact that Ginkgo Bioworks, they've always said in the past that they eventually to receive a bunch of downstream, a bunch of so-called downstream revenue, which is they'll receive royalties when they successfully develop a product for a customer. They will receive royalties on the future sales of that product. And then we talk about how their downstream, in reality, their downstream revenue has been extremely paltry. They in 2023 they only generated less than $5 million of downstream revenue. And our conclusion was that this downstream revenue was mostly BS, and that is never really going to come to fruition. And Ginkgo Bioworks, their current business is unsustainable. They're losing a ton of money, but then they always saying, "Oh, just give us a few more years, and then we're going to get this massive amount of downstream revenue." And we compared it to always promising a pot of gold at the end of the rainbow. Ginkgo Bioworks would always tell the investors, "Yeah, we're losing money now. Just give us a bit more time. We are going to eventually get this downstream revenue, and that's going to help us be profitable." Well, we made the point that they've been saying this for a long time, and for a variety of reasons, we don't think that they're ever going to achieve significant amount of downstream revenue. So when Ginkgo released their Q1 earnings results, our bear thesis played out pretty much exactly as we expected, because they announced that they will no longer be forcing their customers to give them any downstream revenue. And they claimed that was to remove friction in the sales process. But what we think is that basically, because they'd been in the past talking about this this elusive downstream revenue for so long, yet it's never materializing, eventually investors are going to catch on and realize that this downstream revenue that they're always promising is just BS. That's never going to happen. So they're trying to preempt that by coming out proactively and saying, actually, we're no longer trying to get any downstream revenue. That way they have to stop talking. They don't have to talk about it anymore. And then they're trying to kind of brush that all under the rug. So investors will stop, asking them, where is this downstream revenue you've been promising? Now they're saying we're not doing that anymore. We're not even trying to get downstream revenue. But the entire crux of the bull case that they've been trying to sell to investors since they went public was that they expected to receive this massive amount of downstream revenue. Now they're basically admitting that it was all smoke and mirrors, and there's not going to be any significant downstream revenue going forward. So, once they came out and basically disclosed that they're no longer seeking downstream revenue, investors completely lost confidence in the company, because they are losing money, and really the only way they could ever become profitable is with the downstream revenue, which they're now admitting is no longer going to happen. So, there's always this has been, a slam dunk of a short for us, because the stock price is obviously down a lot, and basically our bear thesis played out almost exactly. So our second most profitable short has been Mega Matrix, and we shorted it in January, and since then the share price has declined by about 50%. So similar to Ginkgo Bioworks, we've also released a video on this channel in the past about Mega Matrix. So if you've already watched that and already know what's going on at Mega Matrix, you can feel free to skip ahead. But for the benefit of anybody who doesn't know about Mega Matrix, I will also pull up the short report that we released. So on January 19th, we released the report, and Mega Matrix share price was $3.26 at the time. And we explained that Mega Matrix, they previously were a crypto company, and then in January of 2024, they completely changed the direction of their business by acquiring a streaming service called Flex TV. And it's always, at least in my opinion, a huge red flag whenever you have a company that the original business completely fails. So then they pivot by acquiring or trying to enter, a completely new business, which they have no expertise in, basically just moving on to the next stock promotion. So that was, we thought, a huge red flag. The fact that this company used to be a crypto company, and now they acquire this Flex TV thing, and they're going to become a video streaming company, a completely different business. And then we talked about how they released Mega Matrix. They released these investor presentations, giving like a lot of kind of irrelevant market statistics about like short form video and stuff, which is which we believe is pretty much irrelevant to their own Flex TV company. Because they're talking about how short video penetration rates are very high. So like 95%. That means like 95% of people with smartphones in China and 72% of people with smartphones in Southeast Asia use short form video platforms, which is true. But they're using TikTok and Douyin, which is the Chinese version of TikTok. So basically 95% of people in China and 72% of people in Southeast Asia use TikTok. And then Mega Matrix is saying, look at this, look how popular short form video is. Therefore, our short form streaming service, Flex TV, that we just acquired, is therefore also going to be successful. The problem is they're comparing apples to oranges, because their Flex TV thing is a paid service where you have to buy these virtual coins to watch these extremely low budget stupid films that they make. So how did things play out? Subsequent to us releasing that report, then Mega Matrix released their Q1 earnings results, and they indeed had $9 million of revenue, but based on the nature of how the short form streaming industry works, they are obligated to spend exorbitant amounts of money on digital advertising, like Facebook and TikTok ads, to try to convince people to watch the shows on Flex TV. So they had a massive operating loss, and we believe that because they're losing so much money, they are most likely going to need to do a dilutive equity raise within the next few quarters, which could put downward pressure on the share price. And then, the final stock that we're going to look at today, our third best performing position. Well, I mean, best from the perspective that we were short the stock. In reality, it's the third worst performing stock, was Fuelcell Energy. Fuelcell Energy, we released the reports on April 5th, 2024. And at the time, the share price was $1.13. So we talked about what Fuelcell does. They create fuel cells that can create electricity from either you can use either natural gas or hydrogen as the input to create electricity. And so they create these fuel cell systems and try to sell them to customers. We go over, what their various revenue segments are, etc. We go through kind of like their financial history. We go through the fact that historically, the majority of their revenue came from South Korea, because South Korea has kind of some kind of weird government policies that heavily favor fuel cell electricity generation. So fuel cell had a significant business in South Korea. And they had this partnership with POSCO, which is a giant industrial conglomerate in South Korea. But they had all types of disasters with POSCO, because they would sell the fuel cells to POSCO, and then the fuel cells would be faulty and would need a huge amount of repairs. And it was kind of like a huge disaster. And then POSCO sued fuel cell sued POSCO. And then for a period of time, from 2019 through 2021, fuel cell was not able to operate in South Korea because they had this ongoing litigation with POSCO, and they were not able to operate in South Korea until that litigation is resolved. So that's why the revenue declined there. In 2022, they finally resolved their issues with POSCO. They came to a settlement with POSCO, and they were allowed to begin operating in South Korea again. But during the 3-year period from 2019 through 2021, while they were no longer allowed to operate in Korea, they tried to basically make up for that revenue by expanding their business domestically within the United States. The problem is the United States doesn't have the same kind of subsidies and favorable regulatory environment as Korea does. So basically, the only way that Fuelcell could convince anybody in the United States to buy to basically buy energy from them is to sell it at a massively subsidized rate. So Fuelcell, they created all these fuel cell power plants, and then they create electricity with. Then they signed power purchase agreements with various customers across the United States, but they would sell the electricity at well below their own cost. So they would have extremely negative gross margins. So then in 2022, they finally were able to re-enter the Korean market, and they started generating revenue, but their gross margins were still negative. And then here we kind of went into the weeds of some of the accounting technicalities. But basically, even though they were able to re-enter the Korean market, we don't think it's going to be very profitable because there's basically a ton of competition from domestic Korean companies. And also the Korean fuel cell market appears to be performing poorly anyway. And because there's a Korean company called Doosan Fuel Cell Co., and their revenue has kind of collapsed over the past 5 years. So it appears that the Korean market as a whole, the Korean fuel cell market as a whole, has been shrinking during the past few years. So it seems unlikely that fuel cell will ever be able to, even now that fuel cell is allowed to return to Korea, it seems unlikely that they're ever going to develop a profitable and sustainable business there, because they weren't even profitable in the past, and now it looks like the market is getting even worse. And then we talked about how they've historically burned, they've always been losing money. They've historically burned, they've burned over, since 2016, they've burned over $1 billion in negative free cash flow. And they have diluted their share count massively from 2016 through 2024. Their share count has increased by a factor of 154. So this is, this company can only survive in so long as they can dilute their shareholders and raise more capital. And then we explained that there was an irrational kind of share price bubble in all hydrogen-related stocks, including Fuelcell during the kind of 2021 post-pandemic bubble. And then Fuelcell was able to capitalize on this, on this stock market bubble to issue a huge amount of new shares. So they were able to issue hundreds of millions of dollars worth of new shares, and that bought them a few years. But now even this cash is being burned away. And in the long run, this business is not viable because they're just going to continue, but they're going to continue diluting shareholders and trying to raise as much cash to fund their losses for as long as possible. And now finally, our biggest loser was this company called NextNav. So we released our short report here on April 9th. And then on April 29th, we closed the position and we released a report explaining why we closed the position, but we suffered a roughly 15% loss. So the share price increased by 15% during that time, and we were short, so we incurred a 15% loss. So what did we get wrong about NextNav? So to understand what happened with NextNav, let's first look at our original short report. So this was on April 19th. So NextNav, they create this, they're trying to create an alternative to GPS where they have to put these antennas, everywhere. And then they can use these antennas to create like a GPS type system. But the benefit above a traditional GPS is that the traditional GPS only shows you on XY coordinates. They only show like where you are, on an XY plane. The GPS does not know how high above the ground you are. So, for example, if you are in a skyscraper, and the skyscraper is 30 stories tall, a traditional GPS can see that you are within that skyscraper, but they don't know which floor you're on. Now, NextNav, with their antennas, can identify your position in the XYZ coordinates, so they would see that you're in that skyscraper, and it could also see which floor you are on. Now, the problem with this is it would cost many billions of dollars to actually deploy this system on a large scale because you need huge amounts of these antennas, these terrestrial ground-based antennas all over the place for this to work. And the use cases are extremely limited. Basically, the only use case for NextNav's GPS alternative is for first responders could potentially use it. So like if there's like firefighters going through a building, they can see like which floor the other firefighters are on or something. And then the other use case they had was like the restaurant TGI Friday. They have like a consumer loyalty app, and it can use the GPS to determine when you're physically close to a TGI Friday restaurant, and then it will provide you a push notification with a coupon to try to convince you to eat there. And the idea with NextNav's technology is if you're in a shopping mall with multiple floors, it could tell, if you are on the same floor of that TGI Friday and send you a notification when you're on the same floor. Now, both of those are extremely niche use cases, and it would cost many, many billions of dollars to deploy NextNav's solution on a wide scale. So we said, okay, this is obviously never going to happen because for 99% of use cases, the traditional GPS that we already have is already more than good enough. And this, extremely niche use case of needing to know which floor you're on cannot justify the billions of dollars that it would cost for NextNav to actually deploy this. So that's what we said at the time. However, shortly after we released this report, we received a very helpful email from one of our subscribers. And that subscriber pointed out to us that while it's true that NextNav's business plan is, laughably stupid because the use case is so niche. NextNav also owns some the rights to some spectrum which could be used for 5G. So there's the potential that they could sell their spectrum assets to a big telecom company and make a lot of money that way. So here is the report that we released when we closed the position. We explained that yes, NextNav's business idea is laughable and is never going to happen, but a long time ago, NextNav acquired some spectrum assets, and what spectrum assets are is all telecommunications, right? Like your cell phone signal, etc. Sends electromagnetic waves through the air, and to make sure that different signals aren't interfering with each other, different telecommunications company own the rights to operate in various bandwidths of the electromagnetic spectrum. That way they don't interfere with each other. So NextNav, a long time ago, NextNav acquired some spectrum, and as it turns out, that spectrum is within the same band that can be used for 5G. And there is a potential that maybe they could sell this spectrum asset to a big telecommunications company for a lot of money. And that's a way that, NextNav could, um, could generate a lot of cash, maybe even more than their market cap by selling the spectrum asset, even if their core business plan of their, next generation GPS doesn't work. So that's one huge benefit of the community that we have on differentiated analytics is that our viewers or our subscribers will often give us information that can be very valuable. Because for NextNav, I was just looking at NextNav's core business and what they were trying to do, and seeing that it was incredibly stupid. But I kind of completely it never crossed my mind that they would actually potentially sell the spectrum asset and generate a lot of money that way. Now, as far as I know, they have not yet sold any of the spectrum assets, but they potentially could in the future. And if they do, they could potentially make a huge windfall of cash, and the stock price could go up a lot. So, given that uncertainty, we decided to close the position. And so for paying members of Differentiated Analytics, we have a lot of discussions about stocks via email, and then also we have a Discord server which all paying members gain access to, where we talk about stocks, and we have a very active community there, and that can be very helpful. That can be very helpful also to us if there's anything we missed on any of these our short selling research.
So I've been thinking about something for a while now, James, and I'm not sure I have a great answer for it. But with the exception of NextNav, all the other short positions have been massive winners over the course of the past 6 months, right? Um, the example of Ginkgo is down almost 3/4 by now, right? So what I've been thinking about is, like, especially since the catalyst of the Q1 earnings result, when they announced that they're no longer asking their potential customers for indefinite royalties. Is it time to start lightening up on the position, or even closing that position and just declare victory on the trade? So to me, it kind of makes sense to, now that this catalyst has happened, although the company is likely a zero, so like you could have an unlimited number of minus 75% returns in the future. But to me, it kind of makes sense to kind of declare victory a little bit and take that risk off the table, especially now that the market cap is 4 times smaller, and so it'd be easier for the stock price to increase and get burned by that. I'm just wondering if you have any thoughts on that, on how to think about eventually closing a position once your thesis has started to play out.
Yeah. So obviously you have to do your own this is not, none of this is financial advice. You have to look at your own portfolio and what risks you're willing to take, etc. But kind of broadly, the way that I look at it is there's a few factors into determining the position size. One of them is, especially for a short position, there's a few things to consider. The first is the cost of borrowing the shares. So when we publish a short report, we try to only focus on stocks that have a relatively low cost of borrowing the shares, like less than 10%. And different brokers will have different stockbrokers will have different may have different borrowing rates. I use Interactive Brokers, which, from what I understand, has the lowest borrowing rates in the industry. But so I pretty much only will initiate a short position if the cost of borrow is below 10%. Now, a lot of times, as the stock price is declining because the business is failing and it looks like the business is about to go bankrupt, the short interest will increase a lot. A lot more short sellers will come in, and that will cause the cost of borrow to increase. So maybe you started shorting it when the cost of borrow was 5%. As the stock price has gone down a lot and the more short sellers have come in, maybe the cost of borrow increases to 20 or 30%. And at that point, it becomes very expensive to maintain the short position. And then at that point is maybe when you should take profits. Another thing to consider is that oftentimes when the share price goes below $1, your broker will often increase the margin requirement for maintaining that position. And then that will basically, if your margin requirements are extremely large, then that could put you at risk of a margin call if the stocks move unfavorably. So that's something to consider. And then also, just as the market cap becomes very small, the chances of like short squeezes and kind of a random big increases in the stock price are more likely to happen when the market cap is smaller. So basically, all of those things I was just saying, the conclusion is that as the market cap decreases to, as the market cap decreases closer and closer to zero, the stock will probably become more volatile, more risky, and more expensive to borrow. And so you have to keep all of those factors into consideration when you're thinking about when to take profits.
Staying on the topic of the risk of like short squeezes, and to your point, like as a company gets smaller and smaller in market cap, it has greater propensity to volatility, especially on the upside, which is obviously very bad for short sellers. In the example of NextNav, for example, when or just any short position that where your thesis is not playing out, how do you manage, like, what are some strategies to manage the risk, both when you're putting on the position initially, and then if a short position starts to experience a short squeeze or other unexplainable or explainable increase in price?
So the way I like to do it is I personally, everybody will construct their portfolio based on their own risk preferences. But what I do is I try to have many short positions, but each one being very small. So I might have like 20 or 30 short positions, but each one is only 1% of my portfolio. So I'll have like 30 different short positions, but each one is 1%. So in total, 30, I have short positions equal to 30% of my portfolio value. And then that way, even if, say, like any single short position were to like double in price or even triple in price, I would only lose 2 to 3% on of my entire portfolio. So and the good thing is, if you look at kind of small caps and kind of crappy companies, there are so many like crappy companies out there that are probably good shorts. So if you can find like 20 or 30 of them, you can diversify across a large number of short positions. And then if the stock price is going up a lot, and as the stock price goes up, the position becomes larger as a percentage. So if you start out, you initiate a short position at 1% size of your portfolio, the stock price triples. So now it's 3%. Well, that's getting kind of big there. And, the stock price has tripled. So now it's actually more overvalued. So theoretically, it's actually an even better shorts. But at the same time, it's becoming too big in your portfolio. So maybe you might want to recognize, decrease the size of that position and maybe recognize a short loss, but at least you're managing your risk.
Finally, do you want to explain to the audience why a lot of these short positions that you think are really good are these like very small, crappy companies, as you said, that there's dozens of them in the markets that are opportunities, and why does the opportunity exist in these small companies particularly versus some of the larger companies that some institutional short sellers might be more interested in?
Yeah. So in general, if you look at if you look at our positions, almost all of them are, small caps. I think of the 10 positions, the only one that's over $1 billion in market cap is, I think, Coinbase and maybe CleanSpark. But almost all of the others are under $1 billion. So most of them are pretty small. And the reason I think there's a lot more a lot more short selling opportunities in the micro caps and small caps is because most institutional investors, like large hedge funds or like professional investors managing a lot of money, for liquidity reasons, they're not really able to trade in these micro caps. They're mostly trading in mid and large cap stocks. So therefore, the ownership of micro caps and small caps is much more concentrated by retail investors and amateur investors. And in general, retail investors and amateur investors are much more likely to fall victim to stock promotions and frauds and just generally crappy businesses. So if there's some business that's obviously like an extremely horrible business that's never going to make money, like Ginkgo Bioworks or Fuelcell or Mega Matrix or whatever. And institutional investors who are professional and do this in research companies for a living, they might be able to quickly see, okay, this is a crap company that I'm not interested in buying. But for the micro caps, these companies, they might be able to convince a lot of retail investors to buy into the stock. And kind of these unsophisticated retail investors will basically will buy the shares and cause the share price to trade at an overvalued level. And that's why I think in general, there's a greater opportunity in small caps, because whenever you're investing, you have to think about who's on the other side of the trade. And for these micro caps, you're short the stock. Who's your opponent? I mean, not really your opponent, but who's on the other side of the trade? It's probably some amateur retail investor who doesn't really know that much and can easily be tricked by the company's management. And therefore, if you have done more research on the company than the average retail investor, you have an advantage there. So I hope you all have found this video useful and you now understand, what we offer at differentiatedanalytics.com with our original short selling research. And if you're interested in becoming a premium subscriber, the link to everything is in the description below. We're currently running a promotion where if you put in the code WSM50 at checkout, you will lock in a 50% discount, which will bring the cost of subscribing to just $10 per month. And of course, even if you're not a premium subscriber, make sure to stay tuned to the our YouTube channel, where we will continue to provide great short selling research and commentary for free on the YouTube channel as well. So with all that being said, thank you all for watching, and we will see you on next week's video.